Let me tell you something that might save you years of frustration and losses. Most traders believe their problem is that they need to learn more about markets and build a perfect strategy. So they go looking. They try a new indicator, they join a new group, they buy a new course, they switch from one system to the next, hoping that somewhere out there is the perfect strategy that never loses. But that is not the problem. The problem is not the strategy. The problem is the trader. I know that is hard to hear, but it is the truth. And the sooner you accept it, the sooner everything changes. Here is what is really happening. You have a strategy, it has an edge. Maybe it works 60% of the time. That means in 100 trades, roughly 60 will be winners and 40 will be losers. On paper, that sounds good. That sounds like consistent profit. But then real money is involved and everything changes. When a trade starts going against you, fear kicks in. You close it early to avoid the pain. You take a small loss instead of the full planned loss. That sounds smart, but now your risk-reward ratio is broken. When a trade goes in your favor, greed kicks in. You close it early because you're afraid it will reverse. So now your winners are smaller than planned too. Then you miss a trade because you hesitated. Then you take a trade that was not in the plan because you felt you had to do something. Then you increase your position size after 2 wins because you feel unstoppable. Then you cut your position size after 2 losses because you feel broken. What you end up with is a strategy that on paper makes money, but in your hands loses money. Not because the strategy failed, but because your execution was inconsistent. And inconsistent execution of a good strategy will always produce losing results. That is the real problem, and solving it requires a completely different way of thinking. I want to introduce you to an idea that changed everything for me. Trading is not about predicting what the market is going to do. The market does not owe you anything. It does not care about your analysis. It does not care about your rent. It does not know you exist. What the market does is generate a constant stream of opportunities. Some of those opportunities line up with your edge. Some do not. And even when they do line up, some will win and some will lose. That is the nature of probability. Think about this. A coin flip has a 50% chance of landing on heads. If you flip it 10 times, you might get 7 heads and 3 tails, or you might get 3 heads and 7 tails. Does that mean the coin is broken? No. It means you need a larger sample size before the probabilities reveal themselves. Trading is exactly the same. If your strategy has a 60% win rate, that does not mean trade 1 wins, trade 2 wins, trade 3 wins. It means over 100 trades, roughly 60 will win. The individual trades are random in their outcome, but the pattern over a large sample is predictable. This is the shift in thinking that separates losing traders from winning traders. A losing trader thinks trade by trade. Every single trade feels like the most important thing in the world. A win feels like genius, a loss feels like failure. Each trade carries enormous emotional weight. A winning trader thinks in series, not trade by trade, series by series. They know that a single trade tells them almost nothing, but 100 trades tells them everything. So each trade is simply one data point, one flip of the coin, nothing more. When you truly internalize this, something remarkable happens. The fear goes away, the hesitation goes away, because you are no longer attached to the outcome of any single trade. You are simply executing the next trade in your series, knowing that the edge plays out over time. That is what it means to think in probabilities, and it is the most important mental shift you can make as a trader. Now I want to talk about the strategy itself. And I want to be very clear about something. The strategy is not the secret. The execution is. But you do need a strategy. You need a defined mechanical edge, something with clear rules that you follow every single time without exception. Let me walk you through one simple example, the break and retest strategy. The idea is straightforward. Price breaks above a significant level of resistance. This shows strength. The buyers are in control. Then, price pulls back and retests that same level, which now acts as support. That pullback is your entry point. You place your stop loss below that retested level. Your target is at minimum twice the distance of your stop. That is it. That is the system. Entry has a rule, stop has a rule, target has a rule. Everything is defined before the trade is placed. Now here is what most traders do wrong. They enter the strategy, but then they start making adjustments. They move the stop because price is getting close. They close early because they are nervous. They add to the position because it is going well. Every time you deviate from the plan, you are introducing emotion into the system, and the moment emotion enters, consistency leaves. The strategy only works if you follow it mechanically, every single time. Not when you feel like it, not when the setup looks perfect. Every time the rules are met, you take the trade. Every time the rules are not met, you do not. This is what it means to have a mechanical edge. You are removing the need to predict. You are not asking, what is the market going to do? You are asking, does this setup meet my rules, yes or no? It is that simple. And over 100 trades, that simple yes or no decision, executed consistently, is what creates consistent results. Let me now talk about the one thing that will determine whether you are still in the game in 5 years: risk management. Every single trade you place should risk a fixed percentage of your account. I recommend starting with 1%. That is it. 1% per trade. Not 5, not 10. 1. Why does this matter so much? Let me show you with numbers. If you risk 1% per trade and you hit 10 consecutive losses, you have lost 10% of your account. That is recoverable. You need to make roughly 11% to get back to where you started. Painful, but very much possible. Now imagine you risk 5% per trade. 10 consecutive losses means 50% of your account is gone. To recover from a 50% loss, you need to make 100% on your remaining capital. That is an almost impossible task for most traders. And yet this is the exact situation that destroys trading accounts every single day. Protecting capital is not about being timid. It is about staying alive long enough for your edge to play out. Now let us talk about reward to risk. This is where most traders misunderstand the mathematics of trading. You do not need to win most of your trades to be profitable. You just need to make sure that when you win more than you lose on your losses. Here's a simple example. Imagine you have a strategy that wins 50% of the time. Half your trades win, half lose. Most traders would think that is a break-even strategy, but it depends entirely on your reward-to-risk ratio. If you risk $100 per trade and target $200 per trade, that is a 2-to-1 reward-to-risk ratio. Over 10 trades, 5 winners and 5 losers would give you $1,000 profit and $500 in losses. Net profit, $500, from a 50% win rate. Now take that same 50% win rate but with a 1-to-1 ratio. 5 wins, 5 losses, 0 profit. You grind for nothing. This is why the 2-to-1 minimum rule is not optional. It is the foundation that makes everything else work. It gives your system room to breathe. It means even when you are wrong more often than you are right, you can still make money. And when you combine a positive reward-to-risk ratio with a consistent execution of your mechanical edge, you have the foundation of a profitable trading system. I need to talk about losses now, because this is where most traders fall apart. In our culture, we are taught that losing is bad, that making a mistake is something to be ashamed of, that failure should be avoided at all costs. And we bring this conditioning into the markets, and it destroys us. Here is the truth. Losses are not mistakes. Losses are a cost of doing business. Think about a store owner. They buy inventory. Sometimes that inventory does not sell. They have to mark it down and sell it at a loss. Is that a failure? No, it is just the cost of operating the business. The store owner does not close down because of a markdown. They learn what sells and what does not, and they adjust their inventory accordingly. Trading is the same. A loss is simply the cost of taking a trade that did not work out. It is not a sign that the strategy is broken. It is not a sign that you made a mistake. If you followed your rules, you did nothing wrong. The loss is just part of the business. But here's what happens when traders cannot accept losses. They avoid them, and avoiding losses creates far bigger losses. You move your stop loss further away because you are convinced the trade will come back. It does not. The small planned loss becomes a catastrophic one. You hold a losing trade overnight because you cannot face closing it. It gaps down at open. Now you have lost twice what you planned. You take the trade off the watch list entirely because you are afraid of losing again, and you miss the winning trade that would have made back everything. Avoidance of losses is the single fastest way to destroy a trading account. Accept the small loss, honor your stop, and move on to the next trade. There's a phrase I want you to carry with you always. The traders who survive the longest are not the ones who avoid losses. They're the ones who lose the smallest amounts when they are wrong. Let that sink in.
Every new trader wants to know if they have a winning strategy after 5 trades, 10 trades, maybe 20. You cannot know. You simply cannot know after such a small sample. Trading has randomness in it. Over a short sequence, anything can happen. You could have the best strategy in the world and hit 5 consecutive losses. You could have the worst strategy in the world and hit 5 consecutive wins. Short sequences are meaningless. You need 100 trades before you can evaluate your system honestly. 100 trades, that is your minimum sample size. This is why I say consistency is everything. Not consistency in results, consistency in execution. Your job for 100 trades is not to make money. Your job is to follow your rules perfectly on every single trade. Entry rules, stop rules, target rules, position sizing rules. Every trade, every time. If you do that, the results will tell you the truth about your strategy. If the strategy has an edge, it will show up over 100 trades. If it does not, you will know clearly and you can adjust. But most traders never get this information because they keep changing things. They move the stop on trade 4. They skip trade 7 because they're scared. They double up on trade 12 because they feel confident. They switch strategies after 15 trades because it is not working yet. What they get is 100 trades of 50 different strategies all blended together, and none of them have a fair trial. The data is useless, the results are unreliable, and the trader is left confused, blaming the market, blaming their broker, blaming their luck. The confusion is not from the market. The confusion is from the inconsistency. Commit to one strategy. Execute it with discipline for 100 trades. Then and only then do you have real information to work with.
Let me talk about the psychological patterns that kill traders. Not because they're unique to bad traders, but because every trader faces them, and most traders do not even realize it is happening. The first one is fear. Fear in trading comes in 2 forms: fear of losing and fear of missing out. Fear of losing makes you hesitate at the entry. You see the setup, you know the rules are met, but you do not pull the trigger. The trade runs without you. You feel frustrated. Then you chase it at a worse price and take a loss. Fear of missing out works the other way. You see a trade moving fast without you, and you jump in without a proper setup. You are chasing. You have no plan. And usually you get in right at the worst possible moment. Both of these fear patterns come from the same place. You are treating each trade as if it is the only trade, as if missing it or losing it is a catastrophe. When you shift to thinking in series, the fear dissolves, because you know there will always be another trade, always another setup. The market will be open tomorrow, and the day after, and the day after that. The second pattern is revenge trading. You take a loss, it stings, and something inside you says, I need to get that money back right now. So you immediately take another trade, usually without a proper setup, just to feel like you are doing something. And it loses too. So you take another and another. Revenge trading is the fastest way I know to turn a small loss into a large one. The market does not know you lost. It does not care. It is not your enemy. You are your enemy in that moment. And the solution is simple, but not easy. After a loss, step away from the screen. Give yourself time to reset. The market will still be there in an hour. Your edge will still be valid, but only if you are calm enough to execute it properly. The third pattern is overconfidence. You have 5 winning trades in a row. You feel invincible. You know what the market is going to do. You start increasing your position size. You start taking trades that are outside your rules because your gut is hot right now. And then the inevitable loss comes. And because your position was 3 times normal size, the single loss wipes out all 5 wins. Overconfidence is just as dangerous as fear, and it sneaks up on you because it feels like skill. It is not skill. It is noise. 5 wins in a row happens in every streak. It means nothing about the next trade. Stay humble. Keep your position sizing fixed. Trust the system, not your gut. I want to give you something concrete to walk away with, not a list of vague ideas, a real action plan. Step 1. Choose one strategy and backtest it for 100 trades. Go back through the charts and find 100 historical examples of your setup. Mark the entry, the stop, and the target. Record every single one. Calculate the win rate. Calculate the average reward to risk. See what the system actually produces before you risk a single dollar of real money. This step alone will tell you more about your edge than 6 months of live trading with inconsistent execution. Step 2. When you go live, risk a fixed percentage on every single trade. Start with 1% of your account, not because 1% will make you rich quickly, but because 1% lets you make mistakes without destroying your account. And in the beginning, you will make mistakes, not in your strategy, but in your psychology. You need the space to learn without catastrophic consequences. Step 3. Journal every trade. Before the trade, write down the setup, the entry, the stop, the target, and how you were feeling. After the trade, write down what happened, whether you followed your rules, and what you noticed emotionally. This journal is not just record keeping, it is self-awareness training. Over time, you will start to see patterns in your own behavior. You will notice that you hesitate most on Monday mornings. You will notice that you overtrade after big wins. You will notice that you take the worst trades when you are tired. You cannot fix what you cannot see, and the journal makes everything visible. Step 4. Stop strategy hopping. I cannot say this clearly enough. Every time you switch strategies, you reset the clock. You lose all the data you have built. You lose all the psychological conditioning you have done. You go back to 0. The grass always looks greener with a new strategy, but that feeling of excitement about something new is just your brain looking for a shortcut. There are no shortcuts. There's only the work. Pick one strategy, commit to it for at least 3 months and at least 100 trades. Give it a fair trial, and then, based on real data, decide whether to continue, adjust, or move on. That is discipline, and discipline is what separates the traders who make it from the ones who do not. I want to leave you with something that I want you to think about long after this video ends. Most people come to trading looking for certainty. They want to know which trades will win. They want a system that is always right. They want to remove the uncertainty from the equation. But that is not trading. That is gambling on a fantasy. The true edge in trading is not knowing what the market will do. The true edge is knowing what you will do, no matter what the market does. When your setup appears, you take the trade, not because you know it will win, but because your rules say take it. When your stop is hit, you close the trade, not because you want to, but because your rules say close it. When your target is hit, you take profit, not because you are afraid it will reverse, but because your rules say take it. This is what it means to be a consistent trader. Not someone who wins every trade, someone who executes every trade with the same calm, mechanical discipline regardless of the outcome. And here is what nobody tells you about this kind of trading. When you stop needing to be right, trading becomes peaceful. The anxiety goes away. The desperation goes away. The compulsive checking of charts every 5 minutes goes away. You place your trade, set your stop, set your target, and you let the market do what it does. Because you know something that most traders do not. You know that over enough trades, your edge will express itself. You know that the math is on your side as long as you stay disciplined. You know that protecting your capital today means you get to trade tomorrow and next week and next year. You are not trying to win every trade. You are trying to win the long game. And the long game is won by the trader who is still in the game when everyone else has given up. Stay consistent, stay humble, trust your process, and remember, your goal is not certainty. Your goal is clarity. Clarity about your rules, clarity about your risk, clarity about who you are as a trader. That clarity is what trading in the zone actually feels like, and it is available to every one of you. Not someday, but right now, with the very next trade you place. Take it one trade at a time, execute with discipline, think in series, and let the probabilities do the rest. That is all trading ever needs to be.